There is a higher and higher price for certainty, and fixed income is pretty much the only way you can secure a fixed income asset.
So Mourtaza, investments have been described as uncertain and volatile in the markets at present, and central bank movements have been described as rather unpredictable. So in your opinion, how has this reacted in investment strategies?
I would like to first to say that I would disagree with the premises. I don't think there is more uncertainty than there were years before or even decades before. Remember in the 70s, there was like much higher volatility, uncertainty, I would say geopolitical risk than today. And same thing about volatility. Volatility, even in the numbers, is not so high. It's like even lower than 15 right now as we talk. So I think what changed really is the perception of what is unpredictable and volatile. Our tolerance to risk and to uncertainty have really lowered. That's what changed. I don't think there were a year where there was no uncertainty on markets. So I think for investment strategy, we're very consistent with our approach, which is to weigh possible scenarios and the most probable, and allocate the portfolio in the way of the most probable with sort of tail risk on the side. I would say that regarding our tolerance, I would say the market or investors' tolerance to risk having lowered, or uncertainty getting lowered into a sense of what we can tolerate. We see it in the price of fixed income. All the safe assets like fixed income, where no uncertainty is priced in sort of the future income stream, is much more expensive than it has been in the decades or the years before. So I think this is where things have changed, is the fact that we have a very high price for something certain. But the world is pretty much the same as it used to be, I think.
That's really interesting. So what's your approach to liquidity in the markets and market portfolios at present?
You mentioned central banks, and I think it goes to the question of liquidity. We think first central bank, you mentioned being unpredictable. We see it a little bit in another way, in the sense that we think they're endogenous. They tell what they're doing, and pretty much they say that depending on the market, depending on the economic condition, they will react. And in fact, they are very consistent in reacting the same way. So what really is, I would say, unpredictable is the business cycle, and that's what we look at. Then the liquidity driven by the central bank is sort of a function of how the cycle is going. So we are quite at ease with I would say, the liquidity driven by central banks. They're clearly in easing mode and quite consistent with the mandate. I would see two other pillars in the liquidity issues we have in our portfolio. First is, I would say, crowded trade is position of active managers that have a liability on the side, short-term liability, meaning that when the market is going down, on those positions, they will have to liquidate quicker than other people like long-term investors. So we don't want to be in those crowded trades because then we'll be very, very vulnerable to reversal in markets. And we have seen, I would say, for the last 6 to 9 months, a very sharp reversal on oil, on mining stocks, in banks, even on European stocks as a whole, which makes some sectors very vulnerable to unwelcome risk. So this we try to assess who is buying kind of segment of the market, but it's very hard. And I think this is the first liquidity risk we have, and it's sort of a risk that is rising more and more to the eye of an investor, but not framed properly right now. Second risk is really what we do in our portfolio, is that we go only for index funds, ETF trackers, and so on. So we are quite immune to liquidity issues because we're going mostly for market cap weighted indexes. So we don't have this stock specific liquidity issue, and I think our portfolio on that matter is very resilient. Some people are very worried about ETF risk. I think it's completely misplaced for the European markets, where the ETF market is very regulated and very safe on the liquidity matter. And in the end, this is equities that we have. So we have quite a good risk management on the side of what investments we have in terms of securities, and those securities are quite liquid. So I don't see, except from this, crowded trade issue, a major liquidity risk in the market right now.
And you've given us an overview of how the markets are looking. So is there anything that investors can keep an eye out for and that could help them with their investment strategies?
I think they're usual, of course, business cycle, growth, inflation, looking at the US, also at China, but I would say the macro picture is pretty much what everybody has in mind. I would say, looking forward, I think the key issue is really the fixed income market, and investors, especially private investors, would tend to underestimate the power of duration and power of long-term fixed income, what it brings to a portfolio. Of course, rates are low and it makes that expected return might be very low, but remember, inflation is very low. So in real term, it's still, I would say, still fine. But it brings two things. It brings the correlation, and also it brings something that, as I said, there is a higher and higher price for certainty, and fixed income is pretty much the only way you can secure a fixed income asset. So our view is that it's been 30 years rates are going down. People thought, and we thought, that maybe the bound would be zero, but the bound is not zero. And long-term interest rates are still positive. We think this trend is driven by retirement system. The fact that the aging population forced into a retirement system that forced them to buy fixed income is still there. So there is no change or foreseeable change in this trend, or the driving force of this change in the coming years. We see two things that could change it. Either retirement system is completely blown out, which is not going to happen, fortunately. Second is universal income. Debate on universal income, or I would say another way of helicopter money. This could change the picture in the next decade, but it will take years before really change into the sort of money printing into direct spending for consumer. This could be a driver of change in the fixed income trend. Otherwise, I think private investors should still look an eye on duration, and it's a good diversification for equities.
Fantastic. Well, Mourtaza, thank you so much for coming in today and sharing your insights with us.
Thank you, Jesse.
That's all from myself and Mourtaza, but for all the latest updates and exclusive market moves, do keep clicking back to Dukascopy TV.